All right, what's up, and welcome back, everyone, for season 3, episode 2 of the Long Game Podcast. Today, I am joined by Jesse Cramer. I'm sure if you guys follow me on Twitter, which most of you do, you've seen us engage a lot. I think that we probably have a lot of similarities in what our goal out of social media is, and I think you're kind of one of the better content creators out there, man.
Well, thank you, Tom. That's nice of you to say. Thank you,
Welcome,
and thanks for
dude.
having me on the long game.
Yeah, dude. Let's start with a quick intro of who you are.
Sure. So, my name's Jesse Cramer. I live in Rochester, New York, so upstate New York. I'm 32 years old. By training, I'm an engineer. So I've got 2 degrees in mechanical engineering, and for 8 years worked at a satellite telescope company, so kind of aerospace optical engineering. 4 years ago, though, I started an investing in personal finance blog, a website, mainly because I was helping out my engineering friends with their personal finance and investing questions. I really loved writing, and I just figured it'd be a fun hobby.
Mm-hmm.
That blog kind of took off. It hasn't gone viral by any means, but it took off more than I was ever expecting it to the point where I realized I just enjoyed working with my readers and answering their questions and writing more than I enjoyed being an engineer.
Yeah.
So I started asking some questions around town, inadvertently started an interview process and landed a job where now I work for an RIA, a registered investment advisor here in Rochester.
Nice.
And so we've got, it's a company of about 35 people. We've got about 1,000 clients, and
Wow.
I'm one of the newer people on board. So what am I doing? I'm working with clients one-on-one, especially younger clients, which I enjoy. I'm helping people figure out their financial planning, estate planning, investment management, all that kind of stuff. So
Love that. Love that. A couple of things on there. One is, like, I always preach this to people that, like, if you have any passion, create content about it, write about it, do things that you love, because for you, it probably, from the way you talk about it, it seemed more of like a hobby. It didn't really feel like a job. And sometimes you can do that and turn it into your job, just like you did, which, I mean, I feel like you feel better aligned. The other thing I really love that you did is, one thing that I find is a lot of people feel trapped. I mean, I'm an engineer, I'm a lawyer, I'm whatever. I put so much time and money into specializing in X, Y, and Z, and then realize that you don't really love it. And a lot of people just say, well, I'm just not going to love it, and that's going to be my job. And so I really, really think it's awesome that you said, hey, I'm actually going to chase something that I really enjoy instead of stick with something that I've done a bunch of education on just to stick with it because I spent that money.
Totally. I mean, sunk cost fallacy, it's a real thing, right? It's a real human emotion, exactly like you described it there, Thomas. It's a sunk cost. I've already committed this 6 years of education and however many dollars it was, and 8 years of career growth. But I weigh that against this idea of, do I want to be 50 looking back and saying, well, shoot, I should have made a change 2 decades ago.
Mm-hmm.
So far I can say I'm 7 months in and loving every day of this new job. On a financial point of view, I mean, this is going to be interesting for readers or listeners rather, because I took a pay cut. I took probably a 25% pay cut as of day one. But, I'm hoping that over the next few years, I quote unquote, build my book a little bit here. I get my footing underneath me. And I do think that the ceiling at my current job is higher than the ceiling as an engineer. Engineers tend to have pretty low ceilings. We have high starting salaries, but low ceilings.
Mm-hmm.
And so I'm hoping in the long run, because this is a long game, that the salary, that part of the change works out over time.
Mm-hmm. Well, thanks, dude. Like, I mean, I think that your story is awesome, and I appreciate you coming on. So for everybody to know, quick note, if you hear any like tiny noises, I got a puppy. So if anybody is watching, you can see her back here. Hopefully she's not barking. She's normally really good. But today we're really going to talk about some of the best investing basics. Hold on one sec. I'm going to pause this. Okay, ready? Back. Okay, so today we're actually going to talk about some of like probably the most common questions that you get asked around investing. And then we'll probably end it with some of the recent questions that you've been getting asked by readers. I also saw today, like, people are trying to push you to get back in the podcast game. So this can be like that intermediary questions before you end up starting your own.
Cool. That sounds great. That sounds
So let's
awesome.
just kind of start of like, how do you think about the current state of the economy and how that relates to investing for millennials?
Great question. Like $1 trillion question. Can we, it's not $1 million question. It's $1 trillion question. So I still back in like early COVID days, I think I must have heard this somewhere. Maybe I created it myself, but I doubt it. But this analogy or this metaphor of COVID threw this giant rock into our economic pond. And even after that rock has more or less sunk, which in itself is debatable, the ripples are going to continue for much longer than we're going to see the rock up at the surface, right? And what that means is that the ripples from, say, Federal Reserve policy, from the economy more or less shutting down for 6 weeks or 2 months or whatever it was, that we're going to be feeling that in various ways for years to come. And in short, that's how I feel about what we're seeing right now, whether that's 9% inflation, whether that's interest rates sharply rising this year to combat that inflation, whether that's the stock market kind of spiking in 2021 and then reacting to changing interest rates here in 2022. It's all these ripples that over time will decay, but in the intermediate time, we're going to feel some effects on those. So the message there, or at least the long-term view that I'm keeping, is those ripples will decay. So if you're a longer term investor, if you're someone younger like you or I, Thomas, in their 30s and their 40s with a decade or two until that retirement date and that savings goal of retirement, I have faith that the ripples will eventually decay and we'll get back to some sort of normalcy.
Yeah, I think the important thing here is that like we're all guessing on what we think the future changes are going to be and
Mm-hmm.
how a recession or whatever it is going to impact our investments. For a lot of people though that are in their 20s, early 30s, like you don't have a lot of investable dollars. The name of the game is just to get the money in, right? Because
Yeah.
if we look at, we can't just say, hey, based on the past is what's going to happen in the future with the stock market. But if we look at the past, normally it bounces back, right? Normally we have lulls of 2 years and then, it's supposed to be 6 or 7 good years. And we never know when those are going to come. But the point is that to stick with it, continue to invest and know that 10, 20, 30 years down the line, that the goal is that your money is going to continue to grow even through those bad periods of time.
Absolutely. Like predicting the future of markets and economies is notoriously more or less a fool's errand. And one reason why is because it's so hard. And the second reason why is because even if you're right, like the reward usually isn't that great in the long run. Meaning if you sit there at retirement date at age 60 and you look back and you say, well, darn, I was a genius for calling that recession in late 2022, and I increased my $70,000 portfolio to $85,000 because I called that. Like, okay, by the time you retire, you're going to have most likely $1 million portfolio or greater. That little blip of gain that you got in 2022 isn't really going to matter too much. So again, it's a fool's errand because it's hard to do and the rewards usually aren't worth the risk.
Yeah, and I don't think we necessarily need to go like directly into those studies, but like if you look at the studies, Nick Majouli's put these out, other people has put it out. It's like the perfect market timer. So the person who found the lowest point ever to buy, they held through all those periods of time, only ended up with I think like a 1% per year greater return than somebody who just auto invested in nonstop. And then you
Right.
have the other side of it, the person who tried to time the market, found the worst timing. I think it was only like 1.5% less rate of return over that period of time, which I get 1.5% is good, 1% is good, but nobody's going to do that perfectly anyways. And so trying to do it isn't really the best approach.
Right. And just imagine, like, how are you going to execute that plan too? Like, are you going to stay
Yeah.
glued to your laptop all day and try to figure out, are you going to be worried about it over the weekends, trying to figure out the best time to buy or sell? Like,
And if you were that good at that, you would basically just go get a job, do it, and make millions and millions of dollars running a hedge fund. Like there's a reason why people are not beating, the S&P 500, which I guess leads me into the next question of like, so knowing that, like, what is the best course of action for people to take around investing if we predicting it doesn't make some crazy difference and we really can't predict it?
yeah, I mean, I guess my 2 cents there is dollar cost average, meaning
Mhm.
find a certain dollar amount that you're comfortable investing and a frequency to go along with that dollar amount. For me, that means say $1,000 a month into my 401k that comes out of, every single paycheck, and then $500 a month into my Roth IRA. So
Mhm.
it's set dollar amount, set frequency. And then for me also, it's set asset allocation. So I
Mhm.
know that my portfolio is 80% stock, 10% bond funds, and 10% what we call here alternative assets. Okay, so out of every $1,000 I'm putting in, 800 goes into stock ETFs or stock index funds, you can say, and then 100 into bonds, 100 into alternatives. So that dollar cost averaging into a set asset allocation, that's my baseline for how to approach investing, because you don't know what the future is going to hold.
Yeah, I really think that's the best approach. That's the philosophy we take as well, is have the right asset allocation, continue to buy into it, regular periods of time. The market goes down, buy. Market goes up,
Mhm.
buy. Market stays the same, buy. Continue to just buy and, accumulate more assets for the future. I mean, that really is the name of the game. So then I think next question people say is like portfolio allocation. Like, how do I really come up with the proper portfolio allocation? And I know that we have, high risk people, which might be more 100% equity ETFs or stocks, 0% bonds. We have 80/20. So let's say that we're, the 80/20 person. Like, how do you kind of mix that up? And what is just a good way for people to think about it? Like, I know we can't really give proper allocation advice, but I think we can give an example of what a pretty sound allocation would look like.
Totally, totally. The allocation conversation for me always starts with a person's individual goals, and then the timelines associated with those goals. That's really the important part, is the timeline.
So
So
let's
if someone,
say, so
yeah,
let's say for this example, we're going to do this is retirement dollars or financial freedom 20 plus years out, because you're right. I mean, your goal by far is the most important. If you're investing for 3 years from now, like probably shouldn't be investing. If you're investing 7 years from now, definitely probably shouldn't be in an 80/20 mix. So
hmm,
let's just assume that 80/20 does make sense.
yep, yep. So if someone is investing for retirement multiple decades out, that gives them a pretty wide range of what I would call like responsible asset allocations.
Yeah.
Because if we let's just call it 20 years, just so to give us a number. If you look at 20-year performance of every single asset allocation between 100% stocks, 0% bonds, and the opposite of that, 0% stocks, 100% bonds. If you look at 20-year performances, you're I'm almost positive 100% stocks is going to outperform any other portfolio on that regime over that long of a time period.
Well, and then let's pause there too, because that's
Yeah.
a super important point. Because I think everybody has these ideas of like, the 60/40 portfolio is what people used to do 20 years ago or
Mhm.
whatever. And the thought is, well, is that what we want to continue forward? First of all, have bonds change? But let's just assume bonds stay the same, because that is a whole different argument. So if we're
Mhm.
assuming bonds stay the same, I think what people don't realize is that the goal of bonds is stability. The goal of bonds is also behavioral. So I think this is a whole big discussion too as well, but there's a lot of people who can't manage risk well. And
Yeah.
whether you want to argue that they can't manage this volatility well because they've never experienced it, or because they just simply can't do it, is a different story. But the goal of bonds is, hey, my portfolio, instead of going as far up and as far down, is it's going to go less up and less down. But I'm doing that behaviorally because I know that I'd rather get slightly less return with bonds than sell at a bad period of time. But if you can handle it, less bonds, it should have a higher expected return. That's the goal of having less bonds.
Exactly right. That's exactly right. So that long timeline allows an investor to have a heavier stock portfolio. And then there has to be a follow-on conversation that I bet you're having every day, Thomas, and we're having every day here, which is, okay, just because you're allowed to have 100% stocks from a pure kind of risk time rational point of view, let's talk about how your brain works. Let's talk about how you think. And are you going to be able to swallow the massive ups and downs that are going to come with that 100% stock portfolio?
Yeah.
Or do you need to essentially dampen out that volatility via some allocation of stocks?
Yeah.
Um,
It's
and that,
interesting.
yeah,
I
yeah.
think it's an interesting thing because it's so hard to compare older versus younger, because if you have $5 million and it drops 20% and you're down to $4 million, like that feels bigger than, hey, I'm at $100,000 and now I just dropped to 80,000. But like, from my experience, younger people are better able to handle risk. And I think it's a
Mhm.
mix of like, I don't think really the older generation, their parents really preached investing as much, or they really watched investing. There wasn't Robinhood, there wasn't crypto, there wasn't these things that I think helped people manage volatility better. But like, I'm not seeing many millennials worried. Like, I haven't had one client say, hey, should I make any changes to my investment portfolio? They're more like, hey, how do I like, should I be putting more money in because the market's down, which is such a different view than from older people.
Totally. And some of that, Thomas, it's probably a testament to your client education. And some of it is also a testament to just, I do agree with you. I think our generation, especially those who have money on their mind, like for someone to become a client of yours, a client of mine, they might not be a financial expert, but they have money on their mind.
Yeah.
And so they're at least interested enough in these concepts to seek out professional help. They're interested enough in these concepts to seek out professional content, to read online. And I think by now, a lot of them have been taught through this really solid education that exists all over the internet that, okay, markets do this, markets are volatile, bear markets happen. But up until this point in US history, the US stock market has always recovered.
Yeah.
And that's a reassuring thought that, right, maybe some of our, maybe some of our parents, maybe some baby boomers don't quite have that ingrained in them.
Yeah, I think that's a good point. So I guess going back to, that asset allocation side, like how I think of this is one problem I see all the time is way too much US companies, like no
Mm,
international companies really mixed in. So I always think like, yes, a good portion of your portfolio should probably be US companies. So we have the US companies, we have large companies, we have mid-sized companies, we have small size companies, and then we also have some emerging markets and international. I think that's like the really important mix. I don't
yeah.
know what you think.
Yeah, no, definitely. So our baseline is 70-30 max. So meaning 70% US equities, 30% international equities. So for sometimes we do 70-30, sometimes it's 60-40.
So
And you
you
make a
guys do
great,
have a lot of international, but I guess I do it pretty similar. I just like kind of split out emerging markets and international. So it does
yeah.
end up to be pretty similar to that.
Yeah. And actually it's interesting. This is a good conversation. So I don't know if you're familiar with Meb Faber, who's a podcaster, and I think he runs a company that they create their own ETFs. So he's more of like a CFA as opposed to a planner. But he recently shared something where his personal opinion is that investors, American investors, should not have more than 50% US equities. So he's even more tilted towards international and emerging markets, just because the past does not necessarily confer the future. Meaning, just because US equities have performed at 10% annualized average since, over the last century, it doesn't mean that's going to happen for the next century. And so Meb Faber is positioning his clients with more of an international tilt for that reason.
Yeah, it's so hard because like that's the argument. So we have a lot of people now who favor US countries. It's also there's like part of like or companies also like we see
Mhm.
them more. But the other side of it too is like, okay, well, past performance doesn't dictate future. So like we want to have more. But then if it does stay the same and you have 50% international companies and averages 5% a year, you're giving up a lot. And these are all real guesses. But I think it is important here, like you have to come up with your own beliefs. And then you also talked about the side of like, hey, you have 10% alternatives. Like for me, I believe in like, 5 to 10% alternatives as well. But I think that's like a huge belief of like, what do you believe? Do you believe in Bitcoin? Is that where you want to take it? Do you want to have
Mhm.
gold? Do you want to have real estate? Like, what are those things that you believe in? Because I still think like, yes, you want to follow model, portfolio theories and you want to have a sound portfolio, but also like we have a huge new push of we want to also invest in what we believe in. And I think to have sound investor behavior, you also need to have parts of your portfolio where you are doing the things that you believe in.
I totally agree. Like, I was just having a conversation with a coworker this morning about one of her hopeful new clients, and that lack of faith, so to speak, that lack of trust that he has in his own portfolio. Because if you don't believe in it, then you're going to be the first one to jump off the ship when things go south. Bitcoin that you mentioned there, Thomas, is the perfect example, because one thing we see in cryptocurrency investing, and just with casual investors, is they usually hop on the bandwagon because they see other people making a quick buck. They don't necessarily have that intrinsic faith. They don't have that underlying understanding of how cryptocurrency works. They're just in it to make a quick buck. And then when things start going south, they're also the first ones to jump off the bandwagon because that faith isn't really founded in any sort of firm ground. It's kind of built into quicksand, and that just disappears.
And I think that's why it's also easier to invest in broad-based ETFs than individual companies. Like, hey, do I think the economy and the US stock market or, global market is going to be better 20 years from now? That's a lot easier than, ooh, is somebody taking over Google? Is there a new company that's better than them? Like, you have to be viewing that decision continually. And it's really hard to say, like, I mean, if you look back 50 years ago, like most of the top 50 stocks almost don't even exist today. So it's really
Right.
hard to figure out when that exit is. But I agree with you on crypto. With my clients, I have people who say, hey, I'm interested in buying crypto, blah, blah, blah. And I say, great, here's 5 resources. We have our crypto guide, we have these podcasts, and I want you to go check out this. When you're done with that and you have a base knowledge, come to me. We're going to have a whole meeting talking about it. The only way we're investing in this is if you can tell me specifically why you believe in it. If you say price appreciation, we can't do it. Like, I will not be a part of that for you because it's too easy to believe in something and then it goes from 69 to 20 and you just lost a significant amount of money and you sell. But if you're somebody who's like, I believe in Bitcoin because I believe it's sound money, I believe it solves X, Y, and Z problems, I believe it helps create better freedom, equality, blah, blah, blah. I believe in that technology and I believe that's going to help change things 10, 20 years down the line. Okay, well then the market, when it drops from 69 to 20, your view is, wow, I get to buy more of this awesome thing that I think is going to change the future. That is so different than, oh my gosh, I didn't have a deep belief, so I have to get out of this now because I thought it was going to go up and everybody told me that and now I'm wrong.
Total 100% agreed. 100% agreed. And when you mentioned individual names in the stock market right there, Thomas, it made me think of I don't think the average listener knows this, but if you were to go to Wall Street and you were to find a dedicated stock analyst, now this is someone who probably spends 40 to 60 hours of their work week, their entire work week, looking at individual names on behalf of some investing firm. Most of them are going to be looking at fewer than 10 companies, meaning they're going to spend 60 hours a week studying 6 companies or 8 companies. They're going to spend 10 hours a week on a single company to be, they're going to be an expert on Apple, right? 10 hours a week on Apple. So if you as a more or less hobbyist investor, and I'm speaking to the listeners here,
Who has a full-time job, you're an engineer, a doctor, whatever, you have a family, you have kids, and you don't even have an hour a month to look at your budget, but you think you're going to be picking stocks, right?
That's exactly right. You have to compare yourself to that person and you have to make a judgment call why your opinion on Apple is more of an expert opinion than theirs, why your opinion on Apple's price is different than their opinion on Apple's current price, and why your choice whether to buy or sell Apple at this price is a more educated opinion than theirs on why to buy or sell Apple at this price. It's pretty hard to justify, in my opinion, and that's why, in my own investing and in a lot of our clients investing, just like you mentioned, Thomas, it's broad-based ETFs, it's broad-based funds.
Okay. I mean, that makes sense to me. I think that's like a really good, helpful base knowledge for people. I really do think the point of like having some part of your portfolio that you believe in, that you invest in is crucial, especially to millennials who have already been doing crypto and Robinhood, all those things. Because if you're like, hey, you need to throw every single dollar you have in, between these 3 ETFs, I think like I get that investing isn't meant to be like this fun, thrill seeking, thing like going to the casino. But it is to people. And so you have to meet people where they are and say, hey, we're going to give you 5%, and that 5% you're going to manage however you want. Because what I found too is that I'd say half my clients came in the door because they did that with their whole portfolio and it imploded. And they're like, obviously I can't do this right. And so the way to help people not do that is just start with a small allocation and let them learn that it's really not that easy. And the hard part is also like, for a lot of these people in their late 20s, 30s, they just sat through one of the best bull markets we've ever had. And they're confusing skill with luck. Everybody made money over that 8-year period of time, no matter pretty much what you put your money in. you got to be careful to take that as, hey, I'm a really skilled investor.
Absolutely. And a few things there. First, I was going to ask you, Thomas, what percentage you tend to not allow, but suggest, advise your clients use as that sandbox money? Is it usually 5% where you settle?
Well, it just depends on what you consider that, because like some people consider individual stocks that, and like I have clients who there's no rule of thumb, right? Like, but
Mm-hmm.
I have an example of a client. They are mid 30s, 5 million net worth, 3 rental properties, well over 2 million in the market, but like they have 25 per over, no, almost 30% of their whole portfolio is in between Amazon and Google, because they both work there. They both accumulated them. And it's really hard to approach that conversation, right? Because the compliance financial advisor out there is going to say you should never have more than 5%, 10%, whatever. But if you look at their goals, if they just keep with everything else, they would hit all of their goals they want in life. So it's like, do we sell these, take the taxes to move you down to what the textbook says? Or I'm trying to put myself in your shoes. Those are two companies I really believe in. Would I just sell just to sell? So it's really hard to have those percentages. I think if you don't have a very diverse portfolio, closer to 1%, I think the more money you have, the more on track you are for your goals, or even the farther ahead past your goals are, the more of that percentage you can take, but also the less required it even is to do that. I think the big thing is you don't want to be doing that because you're trying to chase returns above the market, hoping it'll get you somewhere else. I think that's where the danger comes.
Yeah, no, I love that answer. That's a great answer. It's client dependent. Everyone's situation's a little different. And right, if if someone were to say, well, Jesse, I'm going to take 5% of my portfolio and go play the lottery because I'm really hoping to hit it big, like actually buy lotto tickets. Obviously that's a silly example that would never happen, but that's the extreme example where we'd say like, well, wait a second. You can't just chase returns with this money. Even that doesn't really make sense.
Yeah, I'm with you. Okay, well, so to wrap up some of this, like, what are some of the most common investing questions that you're getting from your audience? And let's maybe try to just talk through a couple.
It's a good question. I mean, a lot of them, I'm just thinking back now. I've been writing for about 4 years. For the first 3 years, I got a lot of questions about individual names, individual stock names. For example, GameStop.
And we can't
When
do that here, really. We can't give
right,
any specific investment advice, sadly.
fair enough, totally fair enough. I will say though, I'm not going to give any specific investment advice, and I wouldn't give investment advice when they ask those questions in the moment. Again, the advice, so to speak, or just the more the knowledge shared is, listen, guys, picking individual names is really hard. It's what you and I just talked about for the last 10 minutes, Thomas. So that's one of the big ones. On the personal finance side, I'd say there's quite a good conversation that I'm involved in, just about budgeting is a big one, and whether my personal budgeting method is a bit too zealous, a bit too over the top. So I'm curious, Thomas, like when your clients ask you like, hey, should I have a budget? What should it look like? What do you tend to tell them?
I love you flipping the switch on me here. So what I've come to find is that there isn't a solution that works for everybody, but this is what I found to be the best solution. So this is where I start. And then based on what problems occur from it, then I have tweaks that work. So how I start is I have everybody, we just go through and guesstimate. So we say, how much do we spend on rent? How much do we spend on utilities? More, whatever. What's that number? And then I usually inflate that number by, like, let's say if their number is 6,000, I inflate it to like 7. If that number is like 11, I normally inflate it to like 12, 5, or 13, because I've never come across a single person who they overestimated what they spend. They always underestimate it. So
Gotcha.
because of how we use reverse budgeting, the goal is, okay, hey, I make 15K. We say we spend 10, so I'm going to use 12. We're going to use a $3,000 a month surplus. We're going to automate all of that, because also some people really do overspend because they've never had to have a financial system in place to not overspend. And so getting that money out of the checking account, automating it, helps them figure out what they're allowed to spend, and is kind of that like framework. So what we do is we start there, and then for 3 months, we do that automation. We have them use a budgeting software or app, and we see 3 months from there, what is your checking account at? Because I don't have my clients sit with any extra money in the checking account unless they're like, hey, I have really good behavior. Let's sit with a half a month or 1 month extra income. But let's say that's 5,000. Okay, 3 months from now, is that 5,000 number 1,000? Is that 5,000 number 10,000? And then we're going to look at that budgeting software and get an actual feel, because 3 months is more than 1 month of data, and say, were we right about your spending or were we wrong? And let's also become aware and see, where are you spending? Are you guys happy with this? Do you feel like you're spending too much in certain areas you don't value? We have that conversation, but then we really just continue with reverse budgeting. And then, hey, new income comes in, we now make $1,000 extra a month. Great. X amount's going to go to living. X amount's going to get built into adding to your financial planning. And we run with that. But then some people, what happens is they're still not very good at spending. So what the next step we do is we do this same idea, but then we have one credit card specifically for wants or variable expenses. So we put everything from, rent, mortgage, utilities, groceries, all the things you have to do on one. But then on the other one, we say, hey, we decided that you're going to have $2,000 a month for going out for food, shopping, and fun. Your job is that credit card can't get above 2,000. And so I don't think everybody has to do that. I do think that's a really good method for the people who have a hard time tracking spending and who end up overspending. But I think we start at the easiest. I have not found it sustainable that people continue to budget forever on a monthly. I think there are those breeds. My sister does it. My brother does it with their families. They do it. I don't have any clients who have ever sustained budgeting on a regular basis. So what we do then is every 6 months or 12 months, we'll go back to that budgeting software and say, have you inflated this a lot and done it wrong? And if so, what changes do we need to be made? So I just want it to be awareness, but I think it's really for most people to say, you get 400 on groceries, you get 300 on going out, you get 200 on clothes. That feels really restrictive versus here's how much there. And then, hey, you have $2,000 on your wants. It could be clothes and travel this month. Next month, it could be, going out to doing shows and concerts. It doesn't matter. You get whatever you want on your fun stuff up to a certain price.
I love that. It's a very realist answer, I would say. Right, you're being realistic with how the average person works. And like I alluded to earlier, I've been a kind of a zealot for this stuff for a few years. So I use the app YNAB. I track every single expenditure I make. I can tell you how much I spent at Starbucks last January, down to that nitty gritty kind of, way too detailed. But the average person, and a lot of people that I work with, I'll say, well, let's start with this. Let's log into your bank account on the second and fourth Friday of every month and just start tracking where your bank account is at over time. Is it growing or is it shrinking? If it moves by a lot in that period, can you go into the details and figure out where that spending came from? Are you, if you think that you're saving $1,000 a month, just like you kind of said, Thomas, can we see that in this data over time? And like you said, that's a great place to start. And maybe every quarter or once a year, whatever it is, you can kind of pry into some of the details and say, oh, well, you thought you were spending $300 a month on dining out. You're actually spending $800 a month on dining out. So
I think,
go ahead.
Sorry, I was gonna say, I think that's the important part is you should never just be living out of your checking account and then at the end of the year, see what's left over and be like, here's what I saved, because you're never going to save it. We've talked plenty here about, with bonds and psychology and all these things. Psychology says that you are going to spend that money if that money is in your bank account. If you see 7,000 in your bank account and you want to buy something that's $400, you're going to do that. But if you have $1,000 in your bank account and it's something that you don't really need, you're probably not going to go spend that money, which is why checking account is your living account. That's it. Every other dollar should be moved elsewhere right away, or it's going to lead to bad behavior.
I like it. Cool.
Any other questions that you have that popped up? Maybe one more we could finish with?
Let me think.
How about, have you got questions from people that are are retirement accounts a scam? Because I feel like that's everything that's all over permanent life insurance, LinkedIn and Twitter, or even TikTok of your 401k is a scam. Why would you defer taxes to the future? You have to pay those taxes there. So you should be in a permanent life insurance product that, is your own bank and you get 13% loan, everything that they just try to say. And so I've dealt with people who are drank that Kool-Aid. It was like, I'm not taking my 401k match. Like, I don't think I should be in a Roth IRA. Like, I even had somebody, I had this post blow up that has like maybe 70,000 impressions on LinkedIn. And somebody tried to say that instead of paying off your student loans, 401k or Roth after college, you should be supercharging your permanent life insurance. So then you can use those proceeds to pay off your student loans once it starts to build. I'm like, so we're just going to delay all debt for 7 years until we even hit a break even point on our permanent life insurance. And we're going to take out a loan and then we're going to go pay off debt that's just been accumulating. And they're like, yes. It's like,
Yeah.
what? There's
Yeah.
no way. Like, how can you be believing that and what your company is teaching you enough to not go like read into and understand everything else better than that?
I totally, that's a great, that's a great one for you to bring up because yes, I have gotten those questions. I've gotten even like friends and family have sent me like an Instagram reel or a TikTok before being like, is there anything to this? And I have to be like, well, what happened in that video is someone described an annuity. They described it by another means, but that's what they were trying to sell you, either annuity or a whole life product. And it's very, the insurance industry has always had very, very catchy marketing, right? There's no downs. You get the upside and there's no downside. That's what their marketing has always been. What they don't tell you is that the upside is extremely capped. It's extremely bottlenecked.
And you have all the insurance costs every year that they're not trying to tell you about. And then they give you these, hey, here's what the anticipated is. And it's like 8% year over year return on a product that like, that's just not really what happens.
Right, right. And you know, I know it's easy for some listeners right now to be like, well, you two guys are financial planners, financial advisors, you're not insurance agents, so it's easy for you to poo-poo insurance. But at least I can kind of say, or well, I've been poo-pooing insurance for the last 8 years as an engineer when I had absolutely zero dog in the fight. And
Well,
it's a textbook example of, so Charlie Munger, I'll say this quote. Charlie Munger has this quote: show me the incentives and I'll show you the outcomes.
yeah.
Insurance agents are incentivized heavily by sales commissions to sell more of their products up front. They just want to make a sale and move on. So that's what they try to do.
And I think the hard part about people always say that to me, and I say, I'm a subscription based financial planner. People pay me a monthly fee for me to help them with their goals. Whatever gives them the best outcome and is the best path for their success is what I want to do for them.
Mhm.
My AUM, I have 0.35% and probably 75% of my clients, I show them how to invest on their own because I don't want to take an AUM fee from them. If
Yep.
permanent life insurance was the best solution, which I've had 2 clients use permanent life insurance ever because it actually did make sense for them. I'm not anti it. I only am for it for the right people. This has nothing to do with compensation for me at all. I just really
Right.
believe it's oversold. I think there are benefits to it. I think it's really sold, to the wrong people most of the time. When it is used for the right people, super high net worth people, or, some people who are like, hey, I'm super risk averse. I'm holding $200,000 on the sideline and you want to move part of it to there, great. Other than that, it just doesn't really make sense in most situations, especially for young people.
Right. And I don't know if listeners caught that. I caught it. Thomas, you used the word or the verb sold there twice. You didn't use the verb bought. And it's funny. I mean, insurance
Hmm.
products are usually sold. They're not
Hmm.
necessarily bought. People
That's
don't
a good
usually
point.
seek out these products. Instead, salesmen seek out buyers and salesmen try to sell. So that's, a lot of times insurance products are sold. They're not bought.
Hmm. I love that. Way to catch
Yeah.
that. Well, Jesse, man, I really appreciate you coming on. I'm sure we're going to have you on for another episode in the future. But just let everybody know the best place to follow you before we head out.
Thanks, Thomas. Yeah, this was a lot of fun. I really appreciate you having me on. If people want to connect, easiest way is on Twitter, where my handle is at bestinterest_JC. And yeah, check out my newsletter, check out my website. It is bestinterest.blog.
Perfect. Well, thanks, man. We really appreciate you coming on. And thanks, everybody, for listening again. And we will see you back next week.